Hello all, welcome back to this 14th lecture of our crash course economy for 2022, and external sector is the content of this video. The third chapter of economic survey, it is also called balance of payments. Let us look at the basics now. When we mean external sector, basically we are talking about exchanges with different countries. What kind of exchanges? Trade and cultural exchange. But when we are talking about economy, we are just restricting our discussion to trade only. So in this chapter we'll be looking at the general global trends with respect to trade and what is the impact of COVID. But before that, you have to understand certain basics of the balance of payments, because a lot of questions were asked on this concept in prelims examination. Also, this basics will help you understand what was discussed in this chapter. How will India face future shocks? What is the resilience of Indian economy? What are the metrics that we use? What are the steps taken by the government? Let us understand. What exactly is balance of payments? Let us understand. So when we were talking about trade, we exchange certain things. What do we exchange? Goods, services and assets. What do you mean by exchange of assets? One country or a national of one country wants to invest in another country in the expectation of certain return or profit. In economic parlance, we know this as FDI or foreign portfolio investment. Let us get back to that. Now, generally, when you are exporting goods, you are bringing money into the country. If you are importing goods, you are actually buying from someone else, therefore, money is moving out. So, it is not a positive thing. So, this is the exchange that we are talking about. Now, you have to record this exchange on a systematic basis. That system, which has a certain time period, when it is documented properly according to a format, that is called the balance of payments. So this format is given by an organization called International Monetary Fund. Now, like we have already discussed, assets are of two kinds, FDI and FPI. So what is the difference? How do we use this to generate value in our economy? Let us understand. In this figure, you have to understand what do you mean by volume and what do you mean by value. Let's say a country wants to earn 100 rupees. India wants to earn 100 rupees. It can earn this 100 rupees either by exporting 100 hairpins or one expensive phone. For example, one phone versus 100 hairpins. So in this case, we have volume in the case of hairpins, and in this case we have value, because it is considered to be more valuable across the globe. So what you have to consider is not just on volume but also on high value goods. If you take a look at this economic service graph, after COVID, what happened is both the goods and services which are discussed here, the volume and value both reduced, which is not a good thing. What are the sectors which are performing well according to this economic survey? Certain manufacturing sectors like iron and steel, pharma and electronics. But when it comes to non-performance, basically due to semiconductor shortage, telecom as well as automobiles, which also use the semiconductors, are not performing well. Moving on. So we have seen that balance of payments is nothing but a systematic record of what? Goods, services and also assets. But if you take a look at this from the time period perspective, assets is nothing but a capital which is invested in the expectation of a return. So you have to wait. This is a long term thing. But when it comes to goods and services, within that stipulated time period, on a day to day basis, there will be a lot of change. So this is considered to be current. So balance of payments as such is classified as current account and capital account as per IMF format. We will discuss the components of this current account and capital account soon, but just understand that capital account is something that creates a long term liability or long term profit. It is not immediate. But since it is coming from outside, it is recorded under the capital side. Now, current account is within the same fiscal year. Within this, you have certain components like goods, services, but also you have to record whatever money is coming into the economy from outside the country or outside the economy. Therefore, you have certain other components like income and transfers. Let us deal with each of these components in detail. If India wants to generate more money, it should export more and import less. This is the basic funda for any goods or services. When you're talking about current account, you can further categorize it into visible and invisible. Invisible because they're not tangible, that you cannot feel them directly. For example, a software service, you cannot quantify the software service just like you can quantify goods. They can only be valued at a certain price. So, visible part of the current account is nothing but the goods which are transported across countries. So, if this exports are more than imports, then we are supposed to have a balance of trade which is considered to be in favor of India. But if it is the other way around, that is, imports are more and exports are less, then it is against us, or negative trade balance. Similarly, when we're talking about the invisible components which has services, income and transfers, this component is called the balance of invisibles. It's very obvious. This is the invisible part, this is the visible part, and whatever components are in positive, it will tilt the balance in that favor. Let's say, for example, if balance of trade is in favor of India, then we are supposed to have a positive trade. Together, this will talk about what we know as the current account balance, or it will tell us whether we have a current account surplus or current account deficit. So, in simple words, what we can say is current account balance is nothing but balance of trade plus balance of invisibles. Usually, if we take the trend, we have a negative trade balance. So, overall, what happens is we'll have a current account deficit because we import more than we export. This is the trend broadly in the case of Indian economy. When we talk about merchandise, we basically mean about goods only, not services. And this does not include agricultural exports. Please remember that point. The good news is recently India touched a record 400 billion worth of exports in merchandise trade. But the problem here is the trade deficit, that is, imports are increasing at the same pace. We are importing more and selling less. That is a problem in any given scenario. This is the graph which denotes the same thing. When it comes to merchandise export trends, there are two categories according to our economic survey: POL and non-POL. POL means petrol, oil and lubricants. According to the data from economic survey, there is an increase in exports of this category, that is up to 15% of the exports constitute this category, and the rest of the exports are under this non-POL category. So what are those items and what is the highest export, what is the commodity that is exported at the highest? Basically pharma products. It's quite understandable because of the COVID impact. But apart from that, usually gems and jewelry constitute a very high part of this exports. When it comes to imports, again this is non-POL category only. You can see that we import gems and jewelry, a very significant amount of that in 2021. Almost half of our imports come from gems and jewelry, very understandably gold. We will discuss the implication of this observation at a future point of time. While talking about merchandise exports, I have clearly mentioned that agricultural exports are not considered a part of that. So, during the time of COVID, we have seen that our GVA contribution from agriculture was very significant compared to other sectors because of the lockdown. It was the savior for Indian economy during lockdown. And quite understandably, there is an increase in exports during this particular time. But after that year, after the lockdown restrictions across the world were eased, you can see that there is a significant dip again in agricultural exports, indicating a lack of consistency in our agricultural exports. So it requires a humongous effort from the government and the state governments in increasing these exports and sustaining this level of exports. We have to ensure the food security of the nation and at the same time also export more. And one more observation, if you take a look, pre-COVID times had higher amount of agricultural exports than the present times. So this means that we are yet to recover from the COVID impact as far as agricultural exports are concerned. We did not reach the pre-pandemic levels yet. This is a screenshot of the chart taken from the economic survey top 10 agricultural export products. We have already seen the observation that we did not recover completely from the pre-pandemic times. So what are the commodities? You can download the document from the Telegram channel. This is the channel where I'll be posting a lot of newspaper articles and analysis as well. So you can download the document from here and go through this chart. Similarly, what are the top 10 export commodities? You can download it. Note that petroleum products constitute the highest composition of our exports, followed by certain precious and semi-precious stones. Just note this trend and the trend across the years for individual products, like say the top 3 products. This will give you a sense of understanding and help you in elimination of options in the prelims examination. The top 10 export destinations, just remember the top 2, USA and UAE, and remember that Indonesia was replaced by Belgium. Apart from that, there is another interesting survey observation. So the top 7 destination constitutes about 40% of our markets. Now this means if something happens to these markets, if our relations turn sour because of some reason with these markets, our export trade is in danger. So there is a need for diversification of markets. This is the observation made by survey. We have already talked about the negative trade balance, that is the gap between imports and exports is increasing. Negative indicates that there are more imports. This is the same graph which indicates this observation. Regarding India's trade balance with major countries, you can see that USA is the country with which we have huge trade surplus. Quite understandable because India is considered to be the back office for a lot of IT companies which have headquarters in the US. So we export a lot of services. But when it comes to China, you can see that there is heavy import dependency and therefore we have a negative trade balance. Also, UAE, despite the fact that it is the second largest export destination, we still have a lot of trade imbalance and trade is not in our favor because of the crude oil imports from UAE. And Bangladesh is one very good export destination for India because a lot of commodities from India reach Bangladesh markets. Even day-to-day requirements like onions, there is a heavy dependency in Bangladesh from India. Same is the case with Nepal. But also remember that these are not high value generating items that we export to the neighboring countries, but it is generating a lot of goodwill. But the problem is we have to focus on value, as in the case of US. Now let's talk about imports. Basically, according to the economic survey classification, POL, that is petroleum, oil and lubricants, or simply put crude oil, constitutes around 27%. Gold and silver, as you can see, the top 10 commodities, almost 50% of the imports in our country. When we're talking about the total value, 9% is the amount from gold and silver, but nearly 50% of the imports of non-POL category is from jewelry, precious stones, etc. If you exclude this, non-POL and non-gold, there are certain items like electronic goods, pearls, stones, coal, etc. They constitute around 65%. Another interesting observation with respect to the top 10 import sources from the economic survey graphs, we reduced our dependency on China. This is directly taken from the economic survey. Previously, the percentage was 17.5%. Now it reduced to 15.5%. So if you are asked a question on trends, whether it increased or decreased, we are trying to decrease the dependency on China. Just note this observation, no need to remember the percentages. Secondly, Switzerland. Why is this small country even a source of our imports? It is because of the dependency on Switzerland for our precious stones. That is why we have this. And as far as USA is concerned, the top items constitute mineral fuels, oils, etc. As you can see, this shows the increasing tendency of India to depend more on exports, and even the non-POL items, their share is increasing, which is a cause of concern because you can produce those items in the country as well. That is why there is a push for Atmanirbhar Bharat. Just try to understand the broader themes of current affairs with these graphs. The top 10 import commodities. Now we have seen that current account deficit is a problem for us. So if we handle the top two, that is if we reduce our dependency on fossil fuels and reduce our gold imports, we can handle this issue of current account deficit and improve our macroeconomic fundamental. So any scheme that tries to address this problem is important for us in our examination, and even in the future, if there is any scheme in the news which talks about reducing dependency on crude oil, let's say if we are talking about the topic of e-vehicles or battery swapping technology or any alternative fuels, it is all done to address this issue of reducing the current account deficit, which is a major problem for our country. Therefore, remember such type of issues when they appear in news. What are the rest of the details? You can download them. And another important observation is with regards to this vegetable oils. Nearly 50% of our edible oils are met through imports. That is why last year there was a question on oil seeds, like say for example the palm oil, and even the Indian government is coming up with a national mission on oil seeds. And the Northeast is considered as a very important destination for this purpose. So till now we talked about this visible component. Now let us talk about the invisible component and individual subcomponents of this invisible component of current account: services, incomes, and transfer. As already discussed, current account constitutes both visible and invisible part, and within this invisible part, for easy remembrance, you can use the mnemonic SIT, services, incomes, and transfer. Now when we're talking about services, they contribute roughly around 55 to 60% of our GDP. There is a separate chapter on services itself in economic survey. We will be discussing elaborately in that chapter. Now just remember that 80% of the services that we export constitutes computers, because it's understandable. India's strength is the IT sector. Then you have the business services like financial services, the back end office work that we do for a lot of American and Western companies, the BPOs, etc., that we have for customer service, etc. And then you have the transportation sector. These constitute 80% of the services, and similarly, we also import some services. We have a surplus, just remember, but it does not mean that we do not import any services. There are lot of services that we take from abroad, like say for example the payment solutions for our businesses, the transportation, the travel sector, the computer services. All this together constitute almost 75% of the imports from our services. When it comes to income, there is a concept called net overseas payment. Let's say for example, if Indians invested in another country, let's say for example Tata invested in UK. In fact, Tata is one of the biggest employer in UK. If Tata is earning 100 rupees from its investments abroad, for this particular case, for simplicity, we are just taking only one country, UK. And if some company from UK is investing in India and is generating 120 rupees because of the sheer size of the consumption market, domestic market, then we are actually having net overseas payment which is in favor of UK. So we are having an imbalance. Actually, more income is flowing out of the country rather than coming from outside. Income can be interest, profit, and rents whatsoever. So we pay more. Therefore, there is high net overseas payment. Just remember this term, it is very important. Similarly, when we talk about remittances, a lot of people will be working in different countries. Let's say, for example, workers in Gulf, or a lot of families that have migrated to US, they are sending back money to their families in homeland from US. This remittances is one of the largest source for India. It is considered to be a part of the current account because it is not creating any future liability. Since 2008, India has been the largest recipient, and who says this? World Bank's remittance report. And also, apart from this, there is a global migration report which was mentioned in the Economic Survey and Current Affairs, which is given by the International Organization for Migration. Just remember, these reports can be asked in indices and reports. So, regarding this current account balance graphs, what is the overall observation? You don't have to interpret this graph so deeply. Just remember that we have net overseas payment, which is high, and we are importing more than we are actually selling. So obviously this will lead to current account deficit, and this is what the graph says in a much more complicated way. You don't have to dwell into the details. Now let us understand a term called terms of trade. This is important to understand how a good economy functions. So naturally, if export prices are more than import prices, it means that we are selling more. It should be greater than 100% in a ideal scenario. So here, gross TOT means we are focusing on the quantity that is sold. But in international economics, there is another term called income terms of trade. It is not important to know the formula for this, but this is the important measure to know how our export competitiveness is. So terms of trade refers to the ratio of exports and imports prices. So income terms of trade means how much more income are we generating from exports, or how much less we are exporting. What is the analysis? We already know all these points. Current account deficit is because of crude oil dependency, and we have to focus on reducing our gold imports. So what did the government do to reduce this dependency on crude oil? Strategic oil reserves. I've made a separate video on this. I'll be posting the link. So we have built strategic oil reserves. Then we came up with electronic vehicle policy. Like there are a lot of schemes like FAME. Recently, the battery swapping technologies came into vogue, and the government came into contact with this industry experts and came up with a policy as well. There is an emphasis on alternative fuels, and even the oil companies like ONGC are investing their profits in alternative fuels and new technologies. Similarly, when it comes to gold imports, there are a lot of schemes. You don't have to dwell into the details. These are too old right now. Like there are some schemes like RBI's 80-20 scheme, sovereign gold bond, gold monetization scheme, and sovereign gold coins. All these schemes focus on reducing our gold imports. So in our current account, we were talking about incomes, services, and lastly, when it comes to transfers, transfers means unconditional transfer from one party to another party, and this can be remittances. When I say unconditional, it means that they don't create any future liabilities to our recipients. So donations, gifts, and remittances, all this comes under transfer, part of the invisible component of current account. So what is the trend? In 1920, current account deficit was there, but in 2021, because of the lockdown, because of the fact that we were not importing a lot of oil because of the lockdown, there is a surplus. Again in 2021-22, the trend reversed and we are having a negative current account balance. Now we will move to the current account. Before proceeding further, I have already told you that balance of payments is nothing but a systematic account of current account and capital account, and the net should be zero. There should be a balance between these two. So since we have a current account deficit, it is actually supplemented by a surplus that is there on the capital side. That is why our economy is in a good shape. This is the overall picture. But also remember that capital account creates future liabilities. Let us understand in detail. What are the components of capital account? Let us take a look at the economic survey. So these are the components of our capital account. Firstly, we have foreign investment, and this comes in the form of FDI and FPI. We will discuss that. Secondly, loans. Third one is banking capital, and fourth one is rupee debt service. We take loans from different sources, so we have to pay that money back to the party in the form of interest. Any other capital that is coming to India will also be a part of this. And as far as the capital account balance to GDP is concerned, it is definitely increasing even when you take the pre-pandemic time into consideration. Why is this? Because of Forex reserves. We will be discussing more about this. But let us dwell into the details now. Now let us consider two different cases, taking example of a US entity or a US citizen. If a US entity has a lot of money, let's say for example Amazon, and it wants to invest in Indian markets because we are a population of 150 crores that will spend a lot, huge market. So Amazon wants to invest in our country for a long term. That kind of a long term game plan is called foreign direct investment. They will have their presence here, they will invest in our economy, and they will create employment, which is a good thing. They will also bring new technology with their entire investment plans because it is important for their operations. Even Indians will get to learn from those technologies. Secondly, there is a case of a very rich US citizen who is just looking for certain profits by using the surplus money that he or she has. This high net worth individual does not want the headache of involving in day-to-day activities of a business. For such kind of an investor, there is another option called FPI, foreign portfolio investment. They are only interested in making profit, nothing else. And what is the incentive for us to give them a profit? Because they are giving money at the time of our need. So these are the two different channels through which we get money from our foreigners: foreign direct investment and foreign portfolio investment. You understand the differences between the intent. Now let us look at the technical details. What exactly is this foreign portfolio investment? Let's say a company is worth 100 rupees. So up to 10%, that is up to 10 rupees worth of shares, foreign portfolio investors can invest in that company. This way, according to the laws, they do not have a say in management, but since they are giving money up to 10 rupees, they have a right for profits. At the same time, they can completely remove and sell their shares at any point of time they like. So the problem is it is very volatile, and therefore it is called hot money. But it is considered as FTI if there is more than 10% of share held by a foreign entity. Why is this volatile? You have to understand US Fed rates, and let me explain it further. Let's say for example US Fed Bank or the Federal Reserve there, or you can say the RBI of US, they have an interest rate around 1% to encourage more and more loans so that economic activity is churned up. Now compare that with Indian economy, which is giving around 7% interest in 2013. So obviously they'll take a loan here and invest here. But there is also associated risk with Indian economy. Certain companies might not give the returns that are expected by US. Now US says that I'll increase this to 2% or 3%. Obviously the money will flow back to this country again because it is a safe investment and they're happy with this 3% returns. So this is what US Fed rate means, and this is what US has actually declared in the recent times, and therefore this created volatility. Inflation. In the first chapter we have talked about how as a part of the COVID stimulus, a lot of countries just poured money into the economy. This created inflation. Obviously I'm not going to explain that in detail. If you are not understanding this, go back to the first video. So this volatility is supposed to be handled by the Indian government, and that is why we have a scheme called voluntary retention route. Let's say there is a bond. What is the difference between a bond and a share or equity? In share or equity, basically the company wants to own ownership. So if they're taking more risk, they'll see that the returns are much higher. But in the case of bonds, they'll give a fixed percentage of interest. Let's say, for example, 8%. Now, the investors are not really in a mood to go for bonds in a booming economy like India, which is growing. So they always went for shares, but not bonds. To increase the dependence on bonds, to ensure that they get a fixed return instead of this volatility in the present case, the government wants to ensure that, let's say, if 100 rupees is the amount that an investor gets, and if they retain at least 75% of that for 3 years in Indian government bonds or corporate bonds, then they'll have certain measures which will improve the ease of doing business for these investors. So this is one scheme to attract investors. You don't have to worry about the trivial details about what steps are taken to help their ease of doing business. So this is supposed to create more enthusiasm for debt. This is what you have to understand here from this graph. FPI remain volatile. As you can see, the interest has always been on equity. You can see the share here. Even in times of pandemic, except in this particular quarter, which is considered to be a safe investment, because the economic activity was at an absolute low. In the rest of the times, the emphasis almost is on equity. So Indian government wants to give debt, not equity, because in a growing economy, if equity is given, we are losing out more value. Another good news about Indian economy in the pandemic is the FDI. Despite the slowdown, considering this as an opportunity for growth, a lot of FDI came into our economy. But again, a lot of Hindu articles, criticized because 50% of this money that came into our economy went towards big monopolies like Reliance Jio. So according to those columnists, it is not a good scenario. Anyway, let's focus on what economic surveys is. You can see that there is a zigzag trend, but recovery is slow due to the external shocks that we have. That is what you have to understand. There is no consistent trend in FDI. But in the pandemic times, they reached record levels. Another table from the economic survey, sectors attracting highest FDI equity inflows. Obviously, the highest would be computer software and hardware, and then followed by automobile industry. The next area is services sector. Usually we believe that services sector is the highest, but according to the classification of economic survey, it is the third highest. Note, this services sector means financial. Let's say, for example, fintech, banking, insurance, non-financial or business outsourcing. Let's say, for example, BPOs, R&D activities, because, for example, if you take the case of pharma companies, a part of R&D is outsourced to India because it is much cheaper here. The workforce is much cheaper here. So all this also come under the services sector. Top investing countries or the sources of FDI. The first is Singapore. Please remember this. And the second place goes to US. Big e-commerce giants like Flipkart, they have registered themselves in Singapore to save taxes, and this is a common practice. That is why Singapore is a low tax destination for a lot of startups, for them to register themselves there. Third place is for Mauritius. This is a very peculiar case. You might be wondering why Mauritius is also a source of FDI. Again, this is a place with low taxes. That is why a lot of companies register themselves in Mauritius and set up their offices in India. And Netherlands and Japan come next. So roughly these top 5 countries account for 35% of the FDI inflows that come into our country. So till now we spoke about current account. In capital account we were talking about investments, and other areas of capital account like banking, the loans that are taken, etc. Let us have a look at it. But overall trend of BOP, we have seen that there is always a surplus of capital account over the past few years when compared to the current account. We will see this through a graph now. So this surplus in BOP balance, it is always tilted towards the capital side because more and more FDI, FPI and foreign exchange reserves are coming into our country. So the deficit we have with respect to our current account is actually taken care with the help of the surplus that we have on the capital side. This is what the graph indicates from economic survey. There is a concept called import cover. When we are talking about the capital account, we also take into consideration our foreign exchange reserves. Import cover means for the amount of money we have in foreign exchange, how many months of imports can we actually manage without having any difficulty. That is import cover. So if we take a look at the foreign exchange over the last few years, it has been increasing tremendously. Even in the lockdown time, across the world, foreign exchange reserves were coming down, but in India, because of the influx of FDI and FPI, the foreign exchange was very high. But after January, there was a course correction. That is, a lot of FPIs started moving out of the country, and you can already see this in our financial markets. Say, for example, Nifty, which is a metric which talks about how the best national 50 companies, the top 50 companies of Indian economy are functioning. So this is violently moving between 18,000 and 17,000 in the past couple of weeks, that is in the month of April, which shows that a lot of hot money, that is FPIs, are moving out of the country because of the indication given by US Federal Reserve that they are going to hike the interest rates. So money is flowing out. Therefore, in such a case of volatility, it is important for us to know India's forex reserves and the components. What constitutes the India's forex reserves? Firstly, foreign currency assets. Let's say, for example, dollar is there, euro is there, yen is there. All the basket of currencies that are there with RBI of different countries, they are assets because they will have an underlying value. Secondly, all the gold that RBI has or all the gold that the government has, those gold reserves also constitute forex reserves. Then here we have to understand two important concepts: special drawing rights and reserve position with IMF. Now, for this to be more clear, you have to know the objective of IMF. After the World War in 1945, certain institutions which were supposed to maintain the financial stability of the world came into existence at a place called Bretton Woods. So these institutions are called Bretton Woods institutions. One of the institution is IMF, other one is World Bank, which we will be discussing in much detail in other lectures. Now, what is the objective of International Monetary Fund? It is to maintain that BOP of all countries should be net zero. There should not be surplus, there should not be deficit. All the countries, if clubbed together, it should be zero. That body which maintains this account of BOP zero is IMF. So IMF needs certain funds from all countries to maintain itself and run its business or run its objective or reach its mandate. So IMF came up with a concept called special drawing rights, which is nothing but an asset class which IMF created in 1969. Now, what do you mean by an asset class? This is one type of asset that IMF has, just like how a share paper is valuable for a company, which is a type of investment opportunity for investors. Similarly, here SDR is also a type of an asset class created by IMF. Now, the name itself indicates International Monetary Fund. What is the fund here? Every member, when it becomes a member of that organization, it is contributing to the cause of ensuring global economic stability, because in a globalized world, if even one economy is affected, let's say for example, if China or US is affected, it will have a ripple effect. In order to ensure that kind of scenarios don't happen, we need a centralized body to do this job. Therefore, since IMF is doing that job, every member will pay a certain fee. and how much ever that country contributes, proportionately there will be some quota allotted for deciding on important decisions. So this contribution is not just in the form of national currencies. Let's say, for example, if India wants to contribute, it will pay in rupees, or if dollar is the case in the case of United States. Similarly, respective countries will pay in accordance with their national currencies. Apart from that, there is a unit which is created by IMF, which is called special drawing rights. You can say that this is a type or equivalent to currency, but it is not currency per se, because you cannot go and say give me 10 SDR. There is no such note which has SDR printed on it. It is just a unit which was used for accounting purpose by IMF. Just remember this fact. Now, what is this SDR? Let us understand. Now, all the members joined IMF, and IMF head asked, please contribute. Each country came up with some amount according to their capacity. Now, US, being one of the largest economy, contributed more. So obviously, when members joins and quota is given as per the strength, US, since it is contributing more, it is given more voting power. So what is the formula that decides how much voting power should IMF give to each country? There is a set of parameters which is defined in the documents or charters of IMF. GDP is given 50% weightage, GDP of a country. So in this case, US, being one of the largest economies in the world, is obviously going to have a greater say in the things. Openness, free trade mechanism. Before 1991, India was not a free economy. There was severe licensing, and therefore that period is called license Raj. Therefore, openness is one factor which we scored very low. So we did not have that much voting power in IMF. Then economic variability. Let's say, due to the external shocks, let's say for the case of Sri Lanka, almost 12 to 15% of their GDP, I don't remember the exact numbers, 12 to 15% of their GDP comes from tourism only. So they're too heavily reliant on one particular sector, and because of the lockdown, their economic variability was hit very badly because they did not have any other sector to fall back upon during those lockdown times. And you know the present Sri Lankan economic crisis. So the diversity of sources of economy is also one parameter, and it is given 15% weightage. It is not important to remember the percentages. However, you should be in a position to eliminate options and see which do not make sense. And finally, international reserves. As we have seen in the case of RBI, every country will have its own forex reserves, and the technical parameters required for calculation is not really important. This is also one parameter you just have to know. Now, this quota is just percentage of total. Let's say, for example, if 100 rupees is there, and if this 100 rupees total has increased to a total value of 200 rupees, but still as a percentage the quota will not change. USA, for example, if it has 50%, it will still remain at 50% only. But if you have to look at an absolute number, you need certain quantity, right? That quantity is quantified by special drawing rights. Note, this is not a currency, but it is a unit of measurement in IMF. Apart from this, there is very little practical utility. However, these SDR is a basket of currencies which will be reviewed every 5 years. If certain currencies are meant to be added, they will be added. In 2016, Chinese currency renminbi was added. At present, it is a basket of 5 different goods or currencies, namely US dollar, euro, yen, pound and renminbi. Now, what is the criteria for SDR to include a certain currency? Why is India not included? Basically, criteria here is the top 5 currencies which are a part of exports, like which currency is used while payment for exports by different countries, that will be considered here. And secondly, the availability should be so wide that it is freely usable for trade. All these currencies are widely available. US dollar is the most used currency across the globe. That is not the case with India. That is why it is not a part of SDR. If one day it happens that Indian rupee is also valued so much across the globe, then it will be included in SDR. Take a look here. So US has highest voting percentage, followed by Japan, China, and India is given 2.63 percentage out of the total votes. This is the percentage of voting that we discussed. This is not SDR. Of course, proportionately even SDR is given, but there is certain problem. Do you see across the world SDR is used as a mode of exchange between two countries? It is not the case. You might be using a dollar, you might be using, in the present case, ruble with Russia. But have you ever seen SDR being used for transactions? Let me explain with an example. So, let us imagine that India has one SDR and the value equivalent on that particular day. Remember that SDR is calculated on a day-to-day basis. On that particular day, one SDR value is $1.5. You have to first use this SDR and then convert it to the corresponding currency. That is why the limited scope of SDR is always criticized. Now, why is IMF holding this? The advantage is for countries that are developing, because IMF gives loans at a very low interest rates. During the times of pandemic, IMF came up with a debate whether we should make new allocations at this low interest rate to come out of the COVID crisis, just like in the case of 2009, where a historic amount was poured into the global economy during the global financial crisis. So, this decision was taken based on voting. 85% of the votes should come out in favor of this decision, only then it will happen. But in 2020, it so happened that India and US vetoed this decision, saying that it will give richer countries, because let's say, for example, 50% of the wealth that is created is going to the top 5 countries which are already developed. What about the underdeveloped countries? They're not going to get any additional advantage, right? So it will only push the financial position of the world into a crisis, because inequality will rise, and also poor countries will bear the cost of inflation across the globe. So they did not agree, but again the talks are still going on to get this back on track. However, what is a viable solution if this is the real problem? In order to give push to the poor countries, rich countries like US can transfer their money to the poor countries as a gesture, as a goodwill, because US, if it wants, can raise money from international markets anyway, but the poor countries don't have that facilities because of their credit ratings. That is why US and other rich countries should come forward. Also, when we were discussing in the first chapter about the amount of money spent as a percentage of GDP towards the COVID fiscal stimulus, you can see almost 50% of the GDP, 40% of the GDP. There are a lot of countries which poured in such huge amount, like a waterfall approach which we discussed, leading to the present state of hyperinflation in a lot of small countries. This situation is obviously undesirable, and therefore when we make new allocations, that is, if we want to pump in new money into the economy at such low interest rates, rich countries should not be using this facility, because it is a very lazy way of raising money. Now, when we are talking about forex or foreign exchange, the components included dollar, gold, SDR. We have discussed all this. Now we have to come to the reserve tranche. So let's say, example, India is giving 100 rupees as its contribution to IMF for maintaining the global financial stability. Within this fund, say for example, roughly 25% is reserved as reserve tranche. So out of the total fund as a contribution that we give, this 25% is something that India can use as a matter of right in the first instance when it faces a BOP crisis without any payment of loans. It is our money, since we are only contributing it. That money as a buffer, we can use it in times of crisis. Now the green part you can see here, right? That percentage is reserve tranche. The rest 75%, if this part of the money is used by, let's say, India, we have to pay interest on this. This is therefore called credit tranche. It is not reserve tranche. So together this contributes, this reserve tranche part contributes to the foreign exchange reserves. Basically this is nothing but SDR plus RT together means the money that we give to IMF. So we can simply say foreign currencies, gold and whatever money that we give to the IMF, but the breakdown is important for prelims examination. And finally, to avoid the confusion that you might be having, if any, SDR, though denoted in a basket of currencies, let's say if India is giving rupees, then it will be converted into SDR as per the calculation given on that day and stored at IMF. It is not that we are directly paying SDR kind of a note. That is not the case here. And similarly, when India wants to borrow, it will borrow SDRs, which will again be converted into the currency that India wants and then used. It is a two-way thing. SDR as such is International Monetary Fund's unit of storage. I hope this cleared any confusion that you might have. Now we have to talk about movement in exchange rate, which is given in our economic survey. Let's say, for example, $1 is 75 rupees. Now, as and when this is the case, let's say this is the size of rupee and this is the size of dollar. Naturally, when more amount of dollars are coming into our economy, previously there is a over supply of rupee, that is why it is valued at 75 rupees. Now, if rupee is in more demand, then why will Indian government pay 75 rupees? It will be willing to let go of rupee at a lower cost. Let's say then in that case $1 will become 70 rupees only. This is called appreciation. When foreign exchange moves into our country, currency appreciates. Now this is a bad scenario for exporters. Therefore, countries like China go into a currency war where they try to depreciate their currency, which makes exports very viable, very competitive. So similarly, in another case is FDI and FPI, that is dollars are flowing out of the country. There is a dumping of rupee. This is what happened in 2013-14 when US Fed rate said that we are increasing the interest rates from 0 to 1 or 2%. It is not important to remember the number, just understand the logic. This led to depreciation. So what happened is, in a span of few months itself, dollar went from 48 rupees to 63 and then again to 75 rupees. This violent fluctuation is because of the mismatch between dollar and rupee. We are just talking in the terms of one economy for simplistic understanding, but in real case it is not the case. There is something called nominal effective exchange rate, which is a basket of not just one currency like dollar but 36 foreign currencies. And if you adjust that to the inflation, it is called real effective exchange rate. So our economic survey says, despite this violent fluctuation in 2013-14 over the past few years, Indian rupee did not appreciate or depreciate so much. It is more or less stable according to economic survey. But if we are just talking about in the terms of US dollar, you can definitely see that there is certain amount of depreciation of our value. Now, two concepts that you have to remember here. Purchasing power parity. Let's say, for example, what is this concept? It is a measure of comparing two different economies and the ability of people to purchase something. Let's say, for example, a tea in India costs just 10 rupees, but if you take the same cup of tea in the US, it costs $3. Now, if we actually convert it, it is somewhere around 200 to 225 rupees depending on the exchange rate of that day. Does it mean that a cup of tea which is
very normal at a roadside outlet will cost you 200 to 225 rupees. That would be a scenario in the case of hyperinflation. That is not the case here. So the real measure of comparing economies is not in absolute terms of this size of GDP or other factors, but the affordability, because that is the ultimate measure of well-being actually. But if you have to really use the purchasing power parity, there are certain issues, like say if the economy is simple, if the tea seller can sell at $3 in India, he would be more than happy to do it. But again, if it is available for 10 rupees, and if this tea seller can go to the US and sell it for 15 rupees, even he will be happier, right? But there are certain issues like movement regulations will be there. The tea seller cannot easily migrate to the US, and there are central banks which will be intervening to maintain exchange rate stability. All these issues will be there, which will make PPP a very difficult measure to accurately measure the strength of an economy. But still, policymakers use this as one effective tool to understand the strength of an economy. Now, economic survey talks about economic resilience of Indian economy. This will be decided by certain parameters like inflation, current account deficit, GDP growth rate, debt to GDP. When we talk about debt, we are just talking about external debt. We are not including the internal debt here, because economic resilience to external shocks is what we are talking about here. So, in 2008, there was no money in American economy, and it had a rippling effect across the world. The global financial crisis has actually stalled progress across European markets, North American markets, and it impacted a lot of other countries like India also to an extent. So to increase demand, what US did was it took corporate bonds with certain at least decent ratings and gave money at a very low interest rate, which FDIs and FPIs took and came to India for at least 5 years. So the period from 2009 to 2013-14 was a very good period for these Americans, because they got very good interest rates. But when this stance was reversed in 2014, economy just plunged in India because dollar was moving out. This is called hot money. This made India very fragile. In this context, I want you to comment about the 5 countries which are termed as fragile 5. Now, why is India fragile? Look at these parameters in 2013: inflation, current account deficit, GDP growth rate, and external debt to GDP. All these factors were bad. Inflation was not range bound, that is, it is not between 2 to 6%, which is ideal scenario for Indian economy. Current account deficit is also very high. It should be below 3%, but it was 5 to 6%. Poor GDP growth rate. India was supposed to grow around 7 to 8% or even 9% as per our potential, but it is just 5%. And external debt to GDP, it is 23.9, which is very high. It should be less than 20 for Indian scenario. In order to test the economic resilience of future, we have to look at these parameters in the present times, especially in the times of pandemic. Also, certain other parameters like net international investment position, whether Indians are investing abroad or money is actually moving out of the country. This is what you have to see. So if you take a look, the net IIP has always been negative, that is, more money is flowing out of the country. But in the recent times, the debt is actually decreasing. So money is actually coming into the economy, or at least the rate at which money is flowing out is reducing. That is what we can see. It is a positive sign. At the similar time, assets to liabilities ratio, if we have more assets, it is a good sign. That is also increasing over the past few years. So we can definitely say our net international investment position is increasing, therefore our economy is growing resilient. Similarly, when we are talking about this trade credits, let's say for example, if there is a plastic toy seller in China. We buy in a bulk quantity from that seller and sell in our country, of course at a profit. But the problem is we can pay only after certain amount of time. That credit that buyer gives, let's say if you buy in April and say that I'll pay the entire amount by May, this gap is called trade credit. Even this is considered as a part of the capital account because it is creating a long term liability. So this is also a component of loan that we are getting. This is for the sake of convenience that we are representing like this in the balance of payment. But if we really have to understand what is the total amount of loan that India gets both from internal and external sources, I've already made a video on that, but I'll make a brief presentation on the issue. Out of the total debt, we can classify the public debt as external and internal. Apart from this public debt, there are other liabilities. You have a public account in our country, and this is according to which article of our constitution. I want you to post in the comment section below. Public account, the purpose and why those are considered to be liabilities. Why is there no parliamentary involvement in this? I've already made a video on this. If you did not watch it, please go back and watch this video. I'll be posting the link in the description box below. Now, within the public debt, you have external, that is outside the country, and internal, within the country. I will not be discussing this part here because it is already done in that old video. As far as this external debt is concerned, you either take loan from foreign governments directly or from international markets. You take those loans, and they can be in the form of dollars or they can be in the form of rupee. For example, the debt which is taken through a bond which is denominated in the form of rupee called masala bonds was in news in the last 3-4 years. So please remember this. Also post in the comment section below who issued this masala bonds. Now there is a foreign exchange risk, that is the, let's say for example, if you take a loan where the present dollar value is 70 rupees, it can happen that in the future this dollar is to be returned, but on that day it can be 100 rupees. There is this exchange rate risk associated with foreign currencies. So usually it is not preferred. The reason why India's resilience to external shocks, especially in the case of 2008 crisis, is because we were very much less dependent on this external debt. Most of our debt was internal. Now again, coming back to the format of the balance of payments. So whatever these loans etc. that we have taken from all the sources, it is clearly visible that external commercial borrowings, that is borrowings other than sovereign funds, like say for example the government of UAE itself gave money to the Indian government, that is a sovereign fund. But external commercial borrowings means a bank of UAE is giving funds, or a investment opportunity which was seen by, let's say, a government of Germany or a bank in Germany which is dealing with the pension funds of that country's people invested in our Indian economy. That is external commercial borrowing. So apart from that, you also have within banking, there is NRI's funds, where let's say for example a software employee working in US, he decides to open an account and park his funds in an Indian bank account in rupee. Such kind of a account is called NRO account or NRE account, sorry. At the same time, short term credits which we have seen for trade, that is also a part of the capital account. So what is the trend? Over the past few years, this short term trade credits are reducing, and this NRI deposits and external commercial borrowing is increasing, leading to capital account surplus. Now coming to the analysis part. Is Indian economy vulnerable or not? If you take a look at all these parameters which we have discussed, Indian economy is certainly in a much better position and is much more resilient than it was in the case of 2014's taper tantrum. Taper tantrum refers to the measures taken by US step by step to, excess liquidity is there in the US economy. Step by step, US wanted to absorb that liquidity and hiked the interest rates. Therefore, money came into the system. Again, it was sucked into the system, which had an impact on Indian economy, like we have already discussed. So, in this way, in most of the parameters except net IIP, we have done much more better than previous crisis. Here, you have to understand one important term called debt service ratio. Similarly, in another video, we have talked about interest coverage ratio when we are talking about NPS. Remember the difference. Debt servicing means the ability of an economy to pay back both the principal and the interest. But in the case of banks which are using interest coverage ratio, this is also asked in 2020 prelims. That is why I am giving a clarity. Here, it is a simple metric to ensure that banks at least see that this company is worthy of giving them timely interest. They are only focused on interest. But in the debt servicing component, principal is also there. That is the difference, which is an important metric for testing the vulnerability of an economy when we are taking into consideration the external sector. Now, lastly, before proceeding further, I request you to go and join this Telegram channel, Hindu Highlights, where newspaper articles are analyzed. They did help a lot of previous UPSC rankers as well. If you find some value in that, please keep following it. Now, I will also be posting this PDF in the same Telegram channel. You can download it from there. The last topic of the day is currency convertibility. Now, what do you mean by this? In the balance of payments, we have seen current account and capital account. Let's say, because of whatsoever reasons, if one corporate decides that I'll bring whatsoever amount because India is going to be a very growing country, I want to utilize all the opportunities and create a monopoly. You bring in the money and then suddenly you realize that you're not interested in this anymore. You want to diversify your risk and move out of the country. In such a scenario, it will cause a shock to the economy, just like in the case of hot money. And obviously, we do not need such kind of volatility in the system. So, currency convertibility means the limit up to which the dollars or any other currencies that we bring can be converted into Indian rupees freely without government intervention, both on the current account transactions and capital account transactions. Let us focus more on the capital account because this is the most vulnerable part of our economy. Do we have full convertibility? Obviously not. If there is the case, FPIs will come in and walk out as they wish whenever they make short-term benefits. It will cause a lot of problem to common public. In India's case, as far as the capital account convertibility is concerned, it is regulated by RBI through a law called Foreign Exchange Management Act of 1999. So, through this, RBI created a lot of schemes which controls the outflow and inflow of foreign exchange into our country. We'll get back to that later. So, what is the funda here? Let's say, if the external commercial borrowing requirement of a country is there, RBI will do its own calculations, which is not important for us, and say that some X number is fixed for the entire economy as well as for a particular borrower. If that amount is crossed and some illegal measures are done, like say money laundering, etc., then according to the powers laid down in this FEMA, Enforcement Directorate will come and prosecute the party. Similarly, FPIs, there is a limit set because volatility is caused by FPIs majorly. Out of all the government securities issued by the Indian government through RBI, only 5% amount of money is allowed, 20% in the corporate bonds, that is private bonds. It is not important to remember this number, just remember the logic. FDI, obviously government will regulate through its notifications from time to time. So we were talking about measures taken by RBI. Liberalized remittance scheme is one such scheme where each person up to $250,000, every Indian can take this much amount of money and invest in certain activities in the US and use it as per their wish. But the problem is, using this loophole, let's say if you have $1 million, you divide this into four and send it through four different accounts of four different people and invest it in tax havens like Panama. So this is the controversy of Panama Papers. So this Panama Papers is about the alleged money laundering activities taken by high net worth individuals, including some famous Bollywood actors and politicians, back in the day, like 4 or 5 years ago, about this incident where these sort of schemes were misutilized and it led to money laundering allegedly. We don't have a proper conclusion to this issue, but this is the allegation. So when this kind of scams or this kind of controversies happen, obviously you can understand the impact if full convertibility is there. And if we have to talk about Asian economies, there is a crisis in 1997, Asian economic crisis, which led to the fall of all these Asian economies, like say for example Indonesia, etc. They had full capital account convertibility. It so happened that overnight all the FPIs decided that these economies are no longer profitable and left. This made all the Asian economies crumble like a pack of cards in 1997, which took them years to recover. And we have a lesson from these economies. Therefore, we should not go for full capital account convertibility. In fact, there is also one committee which was set up years ago, and this committee said that unless we meet certain criteria, we are not supposed to even think about such kind of measures. That committee is Tarapur committee, and it talked about having enough forex reserves at least for 6 months, and the fiscal deficit should not cross 3.5% of GDP. Inflation should be range bound, and the gross NPAs should at max be 5%. Obviously, none of these cases are true, except probably maybe for import cover, which might last for around 1 year or more than 1 year. But all the other cases are not true in the present scenario. Obviously, we cannot think of currency convertibility. But on current account transactions, more or less we can say that there is open or free currency convertibility. So these are the important issues from this external sector chapter, both the basics and current affairs and all the important things. Download this PDF from this channel, and I request you to please like, share and subscribe if you found value in this lecture. That's it for now. Thanks for watching.